What's up everybody, Jaspreet Singh here, and yesterday morning the newest CPI inflation data came out and it came in at 9.1%. This is now the new highest inflation that we've seen since 1981. We thought we hit the peak in late 2021, then we thought we hit the peak in like February or March of 2022, then we thought we hit the peak last month, but now everyone's saying that we've hit the peak. I made a video yesterday evening where I covered everything that happened in the inflation report. I want to go a little bit deeper today because, everyone talks about, are we really seeing 9% inflation? Is it better? Is it worse? And a rule of thumb that a lot of people on the internet say is take the CPI number, multiply it by 2, and that's the real inflation that people are feeling. So if we have 9.1% inflation, we're actually feeling closer to 18% inflation. And the reason why, because there is some truth to that, is because the CPI numbers are kind of massaged. And the reason why is because, let me just read it to you. It says in the CPI report that one of the factors driving up this high CPI is the rise in housing costs. And what is said is that we have seen in the last 12 months the fastest rise in home price growth since 1990. Now that seems fair, but the percentage of price growth that they put in the CPI report is 5.5%. Now the reason why is because the CPI data today doesn't look at home prices. It doesn't look at rental prices. It looks at something called owner's equivalent rent. It didn't always used to do that. So when you talk about, the super high inflation that we saw in the 1970s and the early 1980s, they weren't looking at owner's equivalent rent like we are today. This is a newer phenomenon. So what this is if you look at the CPI as a pie and you look at what makes up the CPI thing, there's 8 different parts to it. And one of them is owner's equivalent rent. And that is about a fourth, 25% of the entire CPI pie. Now, this owner's equivalent rent doesn't look at home prices. It doesn't look at rental prices. Instead, what it looks at is you have people that literally survey homeowners and they say, if you were to sell your home tomorrow, if you were to rent your home tomorrow, how much would you rent your home out for? And most homeowners don't have any idea of what the market rent of their home is, so they just give an arbitrary number. And so this is why the CPI data says that home prices, housing costs have gone up by 5.5% because it doesn't look at home prices or rental prices, it looks at owner's equivalent rent. Now you might ask, why would you do that? Why not just look at rental prices or home prices? And the reason why is, like I just said, the CPI data can be kind of massaged because when you look at owner's equivalent rent, now you're not saying 20% housing cost inflation, you're only saying 5.5% housing cost inflation. And this is one of the largest factors into CPI. And this is why many people say that the CPI number, while it says 9.1%, the real inflation that so many people feel is significantly more than 9%. And why? Well, when you have a lower inflation, that allows the government and the Fed to do more inflationary activities, because what causes inflation? Money printing, government spending. And so if the government can continue to spend more money that it doesn't have, if the Fed can continue printing money without fears of inflation or without reports of high inflation, that they can keep doing that. However, now with inflation as high as it is at the CPI number, so if CPI is saying 9.1, that means real people are facing inflation significantly higher than CPI 9.1, because if you went out and tried to buy a home today, it's not 5% more expensive than it was a year ago. It is significantly more expensive. Home prices have gone up by 20%, but then if you factor in higher mortgage rates, you're talking about almost 50 to 70% higher monthly payments on the exact same home with no modifications. By the way, if you keep hearing noise from upstairs, it's because our team is having a little ping pong tournament on the 3rd floor right now. We had a little game before the CPI report came out on people were betting on whether we're gonna see CPI higher or lower than last month. So it wasn't a real bet, we don't gamble, but we had a little fun over there. So that's what's going on. This brings me to now, are we going to be entering stagflation, and what is stagflation? Now, before I get into that, I do want to let you know that if you do want an easy way to stay up to date on what's happening with inflation, with the economy, with real estate, with stocks, you have to join Market Briefs. Okay, let me just break it down. The best way for you to stay up to date on what's happening is to actually read the real reports, the raw data from the inflation reports and the economic reports. However, if you don't have the time or the inclination to do that, then the next best thing is to join something like Market Briefs. It is a completely free financial newsletter that I created where my team breaks down what's happening from the real estate market to the stock market to crypto to inflation to the global economy. It's fun to read, it's witty, it's really easy to read. So even if you don't have a financial degree, I promise you're going to love reading Market Briefs. So if you want to join Market Briefs for free, I'll put the link to how you can do it down in the description below. Now, the interesting thing about stagflation, because I first started talking about what it is and the risks of it in 2021. And the whole idea behind stagflation is you have a slowing economy with higher inflation. And it's a very strange concept because high inflation means a lot of money in the economy, right? You have excess dollars in the economy. That's what inflation is. But a slowing economy means that businesses and people are making less money. So how can you have a slowing economy when there's so much money out in the economy? And it's a strange phenomenon. That's why it's not very common. The last time we really risked something like stagflation and saw stagflation was the 1970s. So it's not a very common phenomenon. And in 2021, when I think that was the first time the Fed even mentioned stagflation, they said that it's not even in the realm of possibilities. It's not possible that we could see it. In the beginning part of 2022, same thing. Stagflation is not even possible. How can you think that we could enter stagflation? And it wasn't until really just like June of 2022 that economists started saying that stagflation is now a possibility. Not that it's going to happen, not that it's a high possibility, but there's a slim chance that we could see stagflation. Again, stagflation means high inflation and a slowing economy. Now, if you look at the factors around us, we're already in that type of economy. We already have a slowing economy. The Atlanta Fed is predicting that we're already in a recession. The first quarter of 2022, January, February, March, we already saw the economy slow down. And now we're going to find out what happened in the second quarter, meaning April, May, and June. We're going to figure that out in the next couple of weeks. We're going to get the report to see what happened in the second quarter. However, if we see that it was a slowdown, that means we're in a recession. While inflation hasn't gone away. It hasn't even started slowing down. I mean, it's still growing. And this is where now you are starting to hear more people worry about, is this stagflation? Are we at risk for stagflation? And the counter argument that the Fed and the government keep saying is that no, we can't have stagflation because we don't have real inflation. According to them, the inflation that we're facing isn't real because they're saying it's all supply chain issues, which is why actually yesterday, as soon as the CPI data came out, you had some directors from the White House saying this high inflation is the reason why we need to pass more government spending in order to fix the infrastructure, to fix our supply chain issues. And I talked about this in yesterday's video, where the CNBC commentator responded by saying, that's kind of a strange thing to say because typically when you have high inflation, you want to cut down government spending because inflation is caused by money printing. And the response was, sure, but we're not worried about the money printing. We need to fix the supply chain issue. And so there's still this whole debate as to what's causing inflation. Is it just supply chain? Is it the inflation? Now, of course, there are supply chain issues out there right now. We can't ignore that. There's issues with manufacturing in China. There's issues with labor shortages. There's issues with part shortages. However, the root cause of the supply chain issues is the inflation problem. I mean, you had all this demand for people to buy stuff, which came from inflation. The Fed and the government spent an insane amount of money while nothing was being produced, nobody was working, which means people had the ability to buy while nothing was being produced. And how do they have the ability to buy? It wasn't because people were working and were generating earnings and were building wealth. It was because the government and the Fed printed money, they spent money and gave it to people, they gave it to corporations. So money was printed, given to people, people had the ability to buy, and nothing could be produced, which created a supply chain backlog, which is what we ended up with, and this is how we got here. So to think that more spending is going to magically fix the inflation problem is kind of interesting. I mean, it's an interesting proposal to think that more inflation would fix inflation. But these are the type of proposals that you have going on. And this is where you should understand that inflation isn't just going to magically go away. So, when we talk about stagflation, yeah, it is a real risk where, you have the price of things going up with economy slowing down, which means wages going down, cost of living is going up. But this is why it's so important now for you to be financially educated, because we don't know which way the Fed is going to go. And you're going to hear me talk about this a lot over the next few months, because this is like literally our economy and markets are coming down to this one factor. What is the Fed going to do? They should fight inflation. In order to fight inflation, you have to do quantitative tightening, pull cash out of the economy, and you have to raise interest rates. Now, this is bad for the economy. It's painful because it causes markets to go down, causes home values to go down, causes stock prices to go down, causes crypto to go down. So it hurts businesses, causes layoffs, and it causes, slowdowns in the market. So investors lose money. However, that is going to be less painful than letting inflation run rampant and creating more inflation, because if the Fed later down the line, before solving the inflation problem, says, we're going to work on the economy now, and we're going to start cutting interest rates, we're going to start stimulating the businesses that are hurting, we're going to start stimulating asset prices, you are going to create a bigger divide between the haves and the have-nots, you're going to create a bigger wealth gap, and you're going to see that asset prices will crash upwards, not downwards, because now when you start cutting interest rates in an already high inflationary time, and you start stimulating when you already have high inflation, well, now people want to get out of cash, so they're going to want to move into assets, and that can cause asset prices to crash upwards. This is where you want to be an investor, because if prices crash upwards, you want to own the assets, and if things crash downwards, you want to be able to buy the assets. This is why it's so important for you to be financially educated, be aware of what's happening, because the reality is our economy is going to go through a weird second half of 2022, where it looks like the consensus is the Fed is going to raise interest rates significantly in the end of July, and we will probably see CPI start to cool down because gas prices have cooled down unless something changes, and that's going to be the trigger now. Is the Fed going to say we won the fight on inflation, even though the inflation didn't go away, or are they going to say we haven't solved the inflation problem yet, so we're going to continue to stay aggressive until inflation comes down? Because the Fed says that their target is to bring inflation down to 2%. Why 2%? Well, I have a video coming out later where I'll talk about that. But the Fed says that they want to bring inflation down to 2%. We're a far way away from 2%. And so if they stay aggressive until 2%, well, we're going to have to go through a recession in order to get there. We're going to have to go through layoffs. We're going to have to see market prices go down, asset prices come down in order to get there. But the question everybody wants to know and everybody will see is the Fed actually going to stick true to what they're saying? So that's where you want to pay attention to what's going on. We'll keep you updated on market briefs, so make sure you subscribe to market briefs if you have not yet. But that's what you want to pay attention to, and this is why you want to have cash put aside and be financially educated. That way you can take advantage of opportunities that come your way, because this is why financial education is so important.
Thank you for watching. If you enjoyed this video and you want to see the 4.5 ways that you can create generational wealth for yourself and your family, I made a video covering that, and you can watch that video by clicking this button right over there. Thank you for watching, and as always, keep hustling. How many times have you seen kids of just rich parents who are completely spoiled, who have no idea of